think the biggest takeaway from the pits is that you would have the high school dropout guy standing in the pit next to the guy who had a degree from Harvard, okay? And the high school dropout guy with all that grit and determination was just as successful, or maybe even more successful than the Harvard guy. It was that sort of kill or be killed mentality. I just found that to be fascinating, how so many of these people were successful, just had lesser amount of education, but they just had determination to win and succeed. And that's one of the things, I think that's really important for anybody that's a trader or an investor is do have to have a certain bit of competitiveness to you. There's that old Ned Davis research saying, do you want to be right or do you want to make money? Okay. And, I'm of the opinion I want to make money. And that's really an important concept I think everyone should understand. And if you go on Twitter or, now X, right, everybody wants to be right. They just want to be right. Well, good for you. I want to make money.
Hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to our latest episode of the Market Misbehavior podcast. Today, we're sitting down with someone I would consider a top technician, Dean Christians. Dean is the founder and lead market strategist at Turning Point Market Research. From humble beginnings on the floor of the Chicago Board of Trade, when I did tease out a good story or two about that time there, we talked a lot about his technical approach. He does a great job of crunching the data, focusing on measures of trend and momentum and breadth and sentiment, but focuses on the evidence. And I think that's one of the most important takeaways of this conversation. Dean quoted one of my favorite analysts, Ned Davis. Do you want to be right or do you want to make money? I'll let Dean explain that quote and why it's so important as an investor, as a trader, as a technical analyst. So please enjoy this conversation with Dean Christians of Turning Point Market Research. Super excited to be catching up today with Dean Christians. Dean is the founder and lead market strategist at Turning Point Market Research. Dean, great to see you again. Thanks for coming on the show.
Hey, Dave. Good to see you. Thanks for having me on.
No, it's great to catch up with you again. For those of you that aren't familiar with your work, and I'm super excited to ask you a ton of questions about process and how you're sort of interpreting the current market activity. But just to start with, give me the first date answer, right? Like what sort of the quick version of your background, what's sort of the journey that you've had as an investor that's kind of set you up for success today?
Sure. So I was a finance major in college and was fortunate enough to take a futures and options class where we traded a paper account. And that's sort of where I got started and got the bug of, investing, was in college. And then I, after college, left Atlanta and went to Chicago and worked at the Chicago Board of Trade in the 30-year bond options pit. And Dave, it was just a wonderful place for a kid fresh out of college to sort of learn about intermarket analysis. Even though I was, in the bond market, you'd have these economic numbers come out in the morning, you'd see what the bonds would do, you'd look and see what the equities doing, and then of course that influenced what was going on with currencies. And spent about 2 years there. And then I joined a local firm back in Atlanta, and we were a large cap growth manager. And of course, it was very interesting times. This was 1998. And of course, that was sort of towards the tail end of the dot-com era. But, I was a young kid and joined the trading desk there. And of course, learned some invaluable lessons in the first sort of 4 years of my career working for a big money management firm. And, at our peak, we had 35 billion under management. We roughly had 30 to 35 names in the portfolio. And so we were heavily concentrated and heavily focused on tech, type names. And, that was a wonderful experience. As working on the buy side, you get access to research from all over the street. And so I took a look at, what were the economists saying? What were the strategists saying? At that time, most of the wirehouses had a technical analysis department. And, and I sort of gravitated towards that technical research department and what they were saying. And that's really sort of what has shaped my investing career is technical analysis, but taking it a step further, really evidence-based, signal-driven type of analysis, and that's what I do today. Taking everything I've learned over a 30-year period and formulating that into my sort of analysis and strategy.
That's awesome, Dean. And it's so funny. You talked about, being a money manager, kind of the 98 to '02 period. I got started in the industry in June of 2000. And I feel like those formative years, those of us that had that experience during that period, those were a lot of lessons learned, I feel like, compressed into years, great lessons on risk management and noticing who struggled mightily through that period, right? It was pretty clear. If I could ask you, because sadly, Dean, there are fewer and fewer people that have firsthand memories of being on a trading floor. In the couple, I was very fortunate to travel to the CBO and CBOT and the CME and others during my Bloomberg days. Can you give us an example of a lesson learned from that experience, actually being on the floor during a challenging period or during an exciting period? What's the biggest takeaway from your time there?
Well, I think the biggest takeaway from the pits, and again, this was back when there was a floor. And what I found was so interesting, right, is that you would have the high school dropout guy standing in the pit next to the guy who had a degree from Harvard, okay? And the high school dropout guy with all that grit and determination, right, was just as successful or maybe even more successful than the Harvard guy, right? And it was, it was that sort of kill or be killed mentality. And I just found that to be fascinating, that how so many of these people were successful, that, just had lesser amount of education, but they just had determination to win and succeed. And that's one of the things, I think that's really important for anybody that's a trader or, an investor is you do have to have a certain bit of competitiveness to you in this business. As we all know, look, this business has gotten significantly more difficult just because there's been more and more new entrants. Even just in general, markets that get saturated, they're just more competitive. And so you've got to have that drive and that competitiveness to succeed and beat the market, as they say.
Yeah. There's such a great kind of blue collar working man feel to the trading pits in Chicago, which I think was just such a cool vibe. I used to love talking to the guys on the floor and just getting a brief taste of what they were experiencing. So I'm thrilled that you kind of echoed the same. To talk about, just to pivot to what we're seeing and how you're sort of approaching the current market environment, Dean. You shared a couple recent notes that I really enjoyed reviewing, and you talked about the wall of worry, right? And we have this situation when the market's kind of grinding higher, and even just in the last week here, early May, we're accelerating to the upside. For those of you to whom that phrase is less familiar, what does it mean that the market's climb a wall of worry, and what kind of evidence are you seeing now that sort of shapes that idea in your head?
Right. So listen, the narrative out there is that, okay, oil's $90, $100 bouncing around, right? That's going to impact the economy. That's one wall of worry right there. Obviously, with sustained or higher oil prices, there could be rising inflation. Rising inflation means that there could be the bond yields are elevated, at a higher level than they probably should be. And so that's that sort of wall of worry that all of this is going to weigh on the economy, and that's not good for stocks. And so that's sort of the wall of worry that we're climbing now is higher oil, higher rates, and that feeding down into companies. And listen, you are seeing it. Consumer discretionary is a sector that is impacted by, again, the elevated rates and elevated oil and stuff like that. And it's underperforming, in a pretty meaningful way. No matter which sort of, if you drill down to sub-industries or even stocks, Housing's a perfect example with the elevated rates, and it's impacting discretionary in a meaningful way. And so, again, if we get relief and we get oil back down to where it was sort of that pre-Iran conflict, and we get, the 10-year back down to 3.7, 3.8, or even potentially lower, then, that could change. And we could see the discretionary names catch up here, and participate. But now, they're really not.
No, it's a really good point. And to your point, I think we're seeing some areas of the market that seem way more affected by what's going on than others. As you're describing it, right? You mentioned you have a pretty technically oriented process, and your work really reflects a really well-defined technical approach to analyzing market conditions. But we also, of course, have to be aware of macro conditions and interest rates and crude oil and gold and all those kind of things. How do you sort of relate what you're seeing on the charts versus what you're reading on the headlines, and how do you sort of combine those into a meaningful approach? Or is your approach more to just focus on the trends and assume that other stuff's just going to kind of work out? How does that sort of relate in your approach?
Yeah. So the way I've analyzed the markets is I look at the big picture, right? Okay, are we in a bullish or bearish regime for the broad market? And predominantly, I'm looking at the S&P 500. And, so I created a model years ago called the Tactical Composite Trend Model. And again, what that does is combine long-term trend following with composite models, which analyze market breadth. And I've got, 5 or 6 different composite models. One's a risk-off model, one's a bottoming model, one's a thrust model, one's a confirmation model. And so I use that model. That gives me the framework to understand that, the environment that we're in, that situational awareness is what you'll hear a lot of times from market participants. Are we in a good environment or a bad environment? And then from there, I take a bottom-up approach. And I have another system I call the dual trend system, and it combines absolute trend following with relative strength. And then that's how I go about identifying what stocks or what ETFs or what indices are in uptrends and outperforming the broad market. And that's, I think, the key as an investor. From a trader's perspective, you can just focus really on absolute trends, and then you're going to just trade high octane stocks. But from an investor standpoint, and I know, you guys focused a lot of this on this at Fidelity, is Dave, if you put the question to me, say, hey, Dean, what indicator could you not do without, and I would tell you relative strength is the one indicator as a, sort of technical analyst that I would have to have in my toolbox. And that's really important because, you have to understand that, in these up cycles, there's certain sectors, certain stocks that are always going to outperform, generally due to the business cycle, right? And they're going to outperform in different periods of time, right? There's, for example, financials coming out of a bear market are going to be your winner initially, right? And then what you're going to see is like technology also win over longer hauls. But relative strength is how we go about finding where we want to be positioned in these cyclical upswings in the stock market.
No, really, really good points. And that concept, that theme of relative strength, you're not the first guest of mine to point that out. And right. I feel like it's my duty to my viewers to just keep bringing people like you, Dean, that reinforce this important message. Because to your point, you're right. At Fidelity, I learned how absolutely vital that was, particularly if you're trying to differentiate among thousands of stocks you're trying to look at, right? Focused on the ones that are outperforming. And if you want to outperform a benchmark, you need to own stocks that are outperforming the benchmark, and relative strength is the way we can do that. Well, I'm going to come back to that because I'd love to talk a little bit more about market leadership and where you're seeing some ideas. But before we do so, I'd love to tease out a little bit more about sort of the big picture technical approach that you have. One thing I picked up from reviewing some of your recent notes, Dean, was a focus on persistence. A number of times you mentioned the persistence of a trend, right? How many weeks or how many days a certain criteria was fitting, which stood out to me. Why is persistence so important in your work? And what observations are you making now about persistence of trend or momentum?
Right. Yeah. So I have a number of different composites, and one of those composites is called the confirmation composite. And within that, there is a a system that looks at the number of consecutive days that the S&P 500 is closed above its 10-day moving average. Okay, so now you might say, well, geez, Dean, why do you 10 days is not a very long duration input. But as you're transitioning from a bear market to a bull market, right, and there's a lot of volatility, what you typically don't see is the S&P or whatever index you're looking at, it doesn't have the ability to sustain above that short-term moving average, right? There's lots of up and downs and crossovers in a volatile environment. But when you transition out, right, it's able to persistently stay above that 10-day moving average. And that's a great signal, okay, of positive momentum that's likely to continue to sustain itself. And you can use longer duration ones too. A lot of times you'll see people measure of, consecutive days above the 50-day moving average. Right now, we're seeing a very healthy win streak in terms of the S&P 500, barring something, a disaster here into the close. We're going to see 6 consecutive weekly gains for the S&P 500. And when you look at the stats, that's pretty good. That's a sign of a healthy trend. A lot of people do analysis like seasonality analysis, but at the end of the day, that seasonality analysis is really just a trend is what it is. And so, again, persistency generally occurs in low volatility environments, and low volatility environments, as we know, are typically uptrends. And so that's why I think it's a very important indicator to have in your toolbox is persistency win streaks.
Yeah, it's a really good point, and I really appreciate in your recent notes, Dean. You do a great job of sort of highlighting the persistence, but then showing what that has usually meant, right, when those sort of trends have happened before. And I think that's really, really good evidence to think about. All right, you mentioned the S word, seasonality. So we're recording this in May, so I have to ask, how much weight do you put in the sell in May, go away, kind of that traditional seasonal weakness going into this time of the year? Is that on a scale of 0, it's meaningless, to 10, this is vital? Where are we at on that spectrum in your work?
Yeah, I don't put a ton of weight in the seasonality studies. I think that, again, what I'm looking at is trend healthy, is breadth healthy? And if that's the case, then usually the seasonality studies will play out, right? And so I put more weight in what is going on with the broad market in terms of external trends and internal trends. And I think, that's just for me, it's a better methodology. I'm not saying that one's better than the other. But for me, I find that more valuable.
You and I are pretty much on the same page, Dean. I tend to pay attention to them, but Chris Verone from Strategist, I think, put it, seasonality is interesting, but at the end of the day, what's happening now is what matters the most. And your process reminds me of Chris's comment there, right? I mean, the trend is the trend. So if the seasonality is going to be reflected in what's happening now, I'm going to see it on the charts. I'm going to see it in the trend, and that matters. Can you talk a little bit more about breadth conditions? Because one of the things that I've been noticing just in the last couple of weeks, kind of mid-April to now early May, we had, obviously a pullback. Then we had a nice kind of upside rotation going into the beginning of this month. Some of the breadth indicators I follow, not necessarily following to the degree that you might want, right? The advanced decline lines are kind of flat to slightly lower, for example. What are you seeing in terms of market breadth? Because I know that's a big part of your process. That either helps you validate what's happening right now or make you skeptical of the new highs we're experiencing in May.
Yeah, listen, breadth is not ideal, but I think, again, what's really happened, and I've touched on this in several of my notes, is really kind of starting last fall, right? Okay, so, the market peaked in sort of late October, early November. That was sort of the start of this period where breadth has just not been great. And we've sort of had these rolling sort of scenarios or events, for lack of a better word. The government shutdown was sort of playing a role in the weak breadth last fall as well. Now you have the Iran conflict. And again, what's that's doing is just creating winners and losers, okay? And the Iran conflict has really created that winner-loser dynamic. Again, if you just look at the tape on a daily basis, if oil drops, right, what happens? Well, all the oil stocks drop, the fertilizer stocks, all those companies, right, that were benefiting from the Iran conflict, they drop, right? And then what happens? Everything else rallies, okay? But again, going back to the sort of elevated oil and elevated interest rate environment, that's really impacting what's going on with discretionary and other areas of the market. And then generally just speaking, in uptrends, you're going to have some weakness, and it's generally out of the defensive groups, right? Because people just don't want to own those stocks. They're focusing more on cyclical sectors and what have you. And then look, we've got some other stuff going on, right? I mean, you think about, these new weight loss drugs, right? That's really impacting consumer staple stocks, right? Whether it's the beer companies or, just generally the snack food companies. So, this type of stuff, it occurs throughout history. I mean, there are periods in history where breadth doesn't align. I was looking at, this is really, really interesting stat, Dave. And I haven't looked at it this week, but, we had gone, and we were still there, something like 345 consecutive days where the percentage of S&P 500 stocks has not been above 70%. Okay. Usually in healthy uptrends, that percent above the 200-day is going to be 70, 80. I mean, sometimes it gets up to 90. But we have not, that peaked prior to the Liberation Day drawdown. And it has never recovered. We got close to 70%, but it's never exceeded it again. And so when you look at that, that streak, I mean, that you only see that in bear markets. Now, the only other time you did have one time in a bull market, and that was sort of in the early 1990s. And if you go back and you look at that period, one of the things you'll see is like the AD line, whether it's NYSE or the S&P 500. I mean, that AD line was going down and down and down. And so coming out of the 90 Gulf War drawdown, you had the recession, right? You had very weak breadth, but you had enough rotation under the surface to where the S&P just kind of grinded higher. It wasn't, a big raging bull market, but it was just a nice grind higher. And look, we could be in one of those sort of periods right now where breadth just isn't great because we have these rolling issues under the surface. But look, at the end of the day, the S&P 500 is going up. The trends are strong, and there are areas, there are opportunities, and again, that's where relative strength comes into play. And so we have to be involved. And there's the old Ned Davis research saying is do you want to be right or do you want to make money? Okay, and I'm of the opinion, I want to make money and not be right about my thoughts about why the market should be doing this or doing that because this indicator is saying this or this indicator is saying that. And that's really an important concept I think everyone should understand. And if you go on Twitter or now X, right, everybody wants to be right. They just want to be right. Well, good for you. I want to make money.
I love that Ned Davis quote. It's a classic one. It's so well put. And I'm glad, Dean, that you brought up sort of that early mid 90s period, because I know in the Fidelity chart room back in the day, we had a big wall size chart looking at the long term breadth, and that was always a noticeable divergence, a disagreement where the market was generally grinding higher. It was sort of a stealth bear market, right? It's like the breadth wasn't nearly as good. And it really took until like the mid 90s, like post 94, when things really started to improve. Then the late 90s, you had kind of the classic bull market behavior where things that should be working felt like they were, and the breadth was starting to expand. But you're right. If you look, there's a period like that I think, that, to your point, market can move higher where the breadth is not particularly supporting it.
Yeah, and remember in the early 90s there, right? You had the healthcare scare, right? Okay,
yeah,
Clinton
that's right. That's right.
And healthcare had one of the worst bear markets in history. And listen, we're seeing some of that right now with healthcare. I mean, some of these groups are we're not talking about underperforming because they're moving sideways; like they're going down, underperforming. Now why, I'm not really sure. But so it happens, throughout history where stuff underperforms.
one of the things that you wrote about in a recent note was about sentiment, and it was about the AAII survey. I thought that was really, really interesting. You mentioned how, we've had the sentiment sort of been mildly bullish for a while. What does the current reading from sentiment indicators tell you about conditions? Should that have us leaning more optimistic about what to come, or what's the message more recently?
Right. Listen, I think when it comes to sentiment, I think generally speaking, most market participants just don't understand how it should be used, right? And again, when sentiment gets bullish, that's a reflection of the fact that investors of different, types of investors are bullish, and that's really important because you need bulls, right, to have a bull market. I mean, if you're confident, right, and the underlying backdrop is positive for the market, you're more willing to hit that buy button, right? Whereas when you're not confident and you're overly pessimistic, what happens? You're scared. You don't want to hit that buy button. And so, again, when you're in a bull market, optimism is going to be sustained at a high level. When you really have to worry about it is when it gets really, really high, and then it starts to turn down, right? So the market is going higher, but sentiment readings are then going lower, which means people are having less and less confidence. And that's generally when you see the problems occur. But, again, sentiment's very, very difficult to read. There's so many different measures now in terms of what it is. And some of the measures just don't have a long history, right? And so, how do you know which one to put the most weight in, right? I mean, generally speaking, when you talk to people, they're going to put the most weight in things like put call ratios, because that's based upon, real money, right? Versus a survey that's just someone's opinion. But, again, I'd look at sentiment and I'll use it occasionally. Like I did, I think you saw in a recent note, where when you get a big jump up from a pessimistic level, that's generally sort of a sign of almost like a sentiment thrust, right? And that's how I'll sort of use it. But generally speaking, I'm not going to sell or reduce exposure just because sentiment's gotten bullish or optimistic, right? That's just not how it should be used.
Yeah, no, really, really well done. And again, I feel like you've served as a myth buster in a lot of ways with some of those sentiment indicators, and I appreciate that, Dean. To your point, I think a lot of people kind of misuse or really don't understand how that can fit into the process. So you mentioned a number of times, right? You've reinforced the fact that the trend in the major average is undeniably positive. I don't think that's debatable at this point. So out of the tools that you apply week in, week out, what are the things, or what would be the I guess the one chart or indicator that you think is the most important one to be watching here to tell you, okay, the party is over, the music has now stopped? Because breadth is not really supporting the move, but the move is still working. So is it some sort of change in trend? Is it some sort of other indicator? And what can you give us specifics about what that change in trend would look like? Or what would you need to see to say, wow, this is no longer a great trend for us?
Right. So my risk off composite has 11 different components. And out of the 11, the vast majority of those have to do with 52-week lows. Dave, I tell anyone, right, in a bull market, the most important indicator to watch is 52-week lows, not 52-week highs. I know a lot of people slap those charts up on, social media, and they'll say, oh gosh, look at today. We're at a new high, but only 1% of stocks closed at a new high. That doesn't matter. What matters are 52-week lows. And when you see the S&P or other indices making new highs and 52-week lows start to rise, that's telling you that there's a problem. And we have had a few things here and there, in the last 6 months where we've seen some 52-week lows rise. Look, just last week, I looked closely this week, like 17% of healthcare stocks hit 52-week lows, but that's not where you want to be looking, right? I mean, where you want to be looking is all right, is the NYSE showing a high number of 52-week lows, right? Or is a critical cyclical sector like financials showing a high number of 52-week lows? And that is the most critical indicator to watch in a bull market. And again, what we've seen now is this extension upwards, right? After the 9% correction and everything extends up. Well, guess what happens? You move further away from those 52-week low pivot points. Now, again, those pivot points will start to rise as the trend goes up. But that is really important, is watching that. And again, I'm not seeing anything from 52-week lows to suggest that, hey, we need to be mindful that there could be a drawdown in the market. So that's the critical one to watch.
Super helpful. I appreciate that, Dean. That's not one that's come up very often. You're maybe the first to really lean into that, and I appreciate you sharing that with all of us. So one final question. I mean, there's undeniably plenty of strength in kind of the AI trade that appears to be going onward and ever upward. I'm curious, with your bottom-up process where you're looking for compelling charts showing strong trend characteristics, outside of kind of that core AI trade, are there other areas of the market that you feel are also deserving our attention? Because I feel like so many are laser focused on the AI stocks that are doing great. Is there anything else that's catching your eye that's outside of that space?
Yeah, listen, some areas within the industrial metals, which have been consolidating. So like, the copper miners have been consolidating now for a while. Now, again, you could say, well, that's just all part of the AI trade, right? We need copper in these data centers. But lithium looks fairly good here. The grains, they pulled back over the last couple of days, but it really looks like whether it's corn or soybeans or wheat, that we've transitioned from a 3-4 bear market now into an uptrend. So I think grains are kind of a place to watch here. And then obviously there's that trickle down effect from grains that, whether it's fertilizer stocks or whatever. But that's sort of an area that I've noticed, in the last couple of weeks that looks compelling. And again, this all kind of fits into the big cycle thing, right? So again, if oil stays elevated, right? I mean, we were at 65 of pre-conflict, and let's just say we say 80 or higher post-conflict, right? Interest rates are probably going to stay higher, right? And then if we start to see the grains turn up and they go higher over, a 1 or 2 year period, then down the road, I think, we could be looking at a situation where there's that, high or sustained inflation. And then that is going to start to trickle into various stocks. And that's where you're going to have your problem, I think, again, will be, where we find our situation where inflation's higher than we want, the Fed can't cut rates. And then, that's where we get sort of a bigger, larger drawdown down the road.
Dean, this was a ton of fun. I really appreciate you sharing a lot of great current market observations, but also a lot of great words of wisdom, some very quotable moments. You need bulls to have a bull market is a new favorite that I just jotted down, which I appreciate. Where can we point people to learn more about you and what you're doing at Turning Point?
Right. So my website is tpmarketresearch.com. You can go there and sort of just, again, I've got a few pages you can learn about me. You can just learn about what we provide on a daily basis. I've got a great video. So for my tactical composite trend model, there's a video on there that, you can watch, and that'll give you sort of an idea of how that model works. Typically provide 2 to 3 research reports a week. Again, we've got a website where we house, the tactical composite trend model as well as our dual trend system. And, that's sort of what we do and how we provide it.
Fantastic. Dean, thanks again for coming on the show. I hope we can continue the conversation down the road. But for now, I'll say thanks for giving our viewers some time today.
Yeah, thanks for having me, Dave.
That Ned Davis quote that Dean shared, do you want to be right or do you want to make money? That was one that Ned himself shared with me and my team at Fidelity when he came to visit years ago, and really enjoyed any time I had, learning from a master like Ned Davis. If you don't know Ned had a wide following in the institutional community. Fantastic work analyzing the data and focusing on what often happens next, given some certain combination of factors or the particular combination that we'd had observed at a particular moment. And he would always reinforce, look, our goal is not to be right. Our goal is not to like crack the code of what's happening. The goal is to make our portfolio grow, right? To benefit our shareholders, to grow our wealth, using that information. And I think that's something that many of us had spent time with Ned and certainly internalized. And I think Dean articulated his ability to do so very eloquently in our conversation today. I love that focus on evidence, right? And a lot of times I know with my own clients, we try to talk about getting from an emotion-based investment process to an evidence-based investment process. Dean mentioned the phrase situational awareness, which is key to my own process as well, right? Making sure that you just have your eyes and ears open and you focus on what's actually happening around you instead of just getting in your head and dwelling on what could happen or should happen. Really appreciated his comments about breadth. I think someone like Dean does a great job of looking at market history, right? And just saying, here's what's happening now. Here's another period, early 90s. We saw a very similar combination. Here's what it meant. Here's how the market was able to go higher. Here are some warning signs I would be looking for that might tell me something's different. I feel like investors get into trouble when they assume that what's happening right now is going to match exactly like what happened in this other period, right? Right now, we are in 1998. We got 2 more years until the 2000 peak. When we talk too shortly and specifically about making a one-to-one comparison, I get nervous. But when someone like Dean, I think, pointed out very well, which is like, look, here's a similar period. So we've seen it can happen. But then, here's what I would be looking for that would tell me things are changing or things are different. And so I think that is a very thoughtful and intellectually honest way of understanding and appreciating the lessons of market history. Really love, a couple of things that were unique about this conversation with Dean, because as you know, if you follow my work, we interview a lot of technically oriented money managers and investors, as well as many, many others. So I always like to try to identify what's a little bit different. I think with Dean, a couple things stand out. Number one, that focus on persistence of trend is really interesting. And I really love his comments about the number of weeks we've had a certain configuration. And what Dean shares is that, the strength that we've seen recently usually leads to further strength, right? If you look back in market history, right, these periods where you've had those stretches, long persistent stretches of appreciation, usually more bull market activity. I also like his comments about sentiment. We just touched on that with the AAII survey, but his quote was, "You need bulls to have a bull market," and I think it was a fantastic quote. Someone like Dean reminds me that process matters, right? The way that you take all the stuff, take all the noise, and filter through it to focus on actionable ideas is crucial. I find too many times investors get caught up in the narratives, they get caught up in the headlines, as opposed to realizing that the goal is to show up every day, every week, every month, and just sort of review the evidence and have an open mind and open attention to when that narrative changes, when those trends change. Thanks again, Dean Christians from Turning Point Market Research, joining us on the show. Really good to get his take, and I hope we can have him back again down the road. By the way, if you want to learn more about how to upgrade your own process, how to show up every day, every week, every month, develop a good system and good set of routines so you can make better decisions in your own portfolio, our Market Misbehavior premium memberships may be the thing you need. 3 great benefits to the premium membership. First off, we will teach you all about technical analysis and behavioral finance through our virtual courses. Second, we will keep you informed and updated and inspired, I hope, with our weekly flight plan, which is our main investment report, and our monthly chart review, a key important process to gather the evidence about long-term trends and changes in those trends. Finally, you'll have full and immediate access to a member community where you can ask questions, where you can learn from like-minded investors and go on this journey of more mindful investing. If that sounds of interest to you, please go to marketmisbehavior.com/premium to learn more information about our premium memberships. That'll do it for today's episodes. My name is Dave Keller with Market Misbehavior, reminding you, as always, it is always a good time to own good charts. Take care, folks.